Congratulations, you're a millionaire. You've hit that magic seven-figure number that everyone dreams about. The number that's supposed to change everything. The number that means you've made it, right? So, why does it feel like absolutely nothing has changed? Why are you still checking your bank account nervously? Why does retirement still feel impossibly far away? And here's the really messed up part. Why do you feel more trapped now than you did when you were broke? If you've ever thought $1 million was the finish line, this video is going to completely rewire how you think about wealth. Because here's what nobody tells you. $1 million isn't the goal. It's barely the starting gate. And if you don't understand why, you're about to fall into the biggest trap in personal finance. Before we dive into the numbers and the scary reality check, hit subscribe and turn on the bell. If you want more videos that explain money without the boring textbook vibe, this channel is going to be your new favorite place for real talk about wealth. Now let me show you exactly what's going on. The Millionaire myth is one of the most successful marketing campaigns in human history, and you've been sold on it your entire life. Think about it. Every movie, every song, every motivational poster uses $1 million as the symbol of having arrived. It's the number that separates the winners from the losers, the successful from the struggling, the free from the trapped. But here's the truth that's going to sound absolutely insane until I break down the math. In today's economy, $1 million is closer to being broke than it is to being wealthy. Sound dramatic? Stick with me because the numbers don't lie. Let's talk about what $1 million actually gives you in real practical terms. If you follow the standard financial advice, which says you can safely withdraw 4% per year from your investments without running out of money, $1 million generates $40,000 annually. $40,000, that's it. Before taxes. In most major cities, that's barely enough to cover rent and basic expenses. That's not yacht money, that's not retire to a beach house money, that's barely scraping by money. And if you're under 50 years old when you hit this milestone, you're looking at potentially 40 or 50 years of living on that income. Does that sound like the freedom you imagined? But the psychological trap goes even deeper than the math. Something fascinating happens to people when they hit $1 million. They experience what psychologists call the arrival fallacy, the belief that reaching a goal will bring lasting happiness and fulfillment. You spend years, maybe decades, grinding toward this number. You sacrifice, you save, you invest. You tell yourself that once you hit 1 million, everything will be different. Then you wake up one morning, check your net worth, and see that magical seven-figure number staring back at you. And nothing feels different. Your apartment is the same. Your car is the same. Your daily stress is the same. The world didn't suddenly recognize you as successful. Nobody threw you a parade. Here's what makes this moment so dangerous. Instead of recognizing that the goal itself was flawed, most people assume they just need more. Just a little more, and then they'll feel successful. Just a little more, and then they can relax. So they keep grinding. But now with a new problem. They've lost the hunger that got them to 1 million in the first place. They've proven they can build wealth, so the urgency disappears. The discipline softens. The sacrifices feel less worth it. And slowly, almost imperceptibly, they stop doing the things that made them a millionaire. They start spending a little more freely. They start taking their foot off the gas. They start thinking they've earned the right to relax. Meanwhile, inflation is eating away at that 1 million every single day. What bought you $40,000 worth of lifestyle this year will buy you less next year, and even less the year after that. The purchasing power of your million is shrinking while you're standing still, congratulating yourself on an achievement that was already outdated the moment you reached it. This is the millionaire's paradox. The number you thought would set you free actually just gave you new problems to solve and new anxieties to manage. But here's where it gets interesting. And this is what the rest of this video is going to reveal. The second million is completely different. The game changes after you cross 1 million. The rules shift. The opportunities multiply. The speed accelerates. Everything you struggled with to earn that first million becomes easier, faster, and more powerful when you're building the second. Why? Because money doesn't just add up linearly, it compounds exponentially, and 1 million is right at the inflection point where that exponential curve starts to really take off. The wealthy understand this, the broke don't. And that difference in understanding is what keeps the gap between them growing wider every single year. So if you're sitting there with your first million, or if you're working toward it, I need you to completely reframe how you think about this milestone. It's not the destination. It's not even close to the destination. It's the moment when you've finally built enough mass for gravity to start working in your favor. It's the moment when wealth building stops being about your effort and starts being about the system working for you. But only if you don't fall into the trap, only if you keep building, only if you understand that the real game is just beginning. In the next chapters, we're going to break down exactly why the math changes after 1 million, what the psychological traps look like, and how the second million happens faster than you think. But first, you need to let go of everything you thought you knew about what it means to be a millionaire. Because that story you've been told your whole life, it's designed to keep you stuck right where you are. Let's do something that most people avoid because it's uncomfortable. Let's actually run the numbers on what $1 million gives you in real life. Not the fantasy version you see in movies, not the lifestyle you imagine when you daydream about being a millionaire. The actual, brutal, unglamorous math. Because once you see these numbers, you'll understand exactly why 1 million is a trap, not a destination. Start with the most conservative and widely accepted withdrawal strategy, the 4% rule. This rule says you can withdraw 4% of your portfolio annually and have a very high probability of not running out of money over a 30-year retirement. 4% of $1 million is $40,000 per year. Now, before you think that sounds reasonable, remember this is before taxes. Depending on where you live and how your money is invested, you could easily lose 20 to 30% to federal and state taxes. That $40,000 suddenly becomes $28,000 to $32,000 in actual spending power. That's about $2,600 per month to live on. Sound familiar? That's barely above the poverty line in most developed countries. But let's be generous. Let's say you're more aggressive with your withdrawal rate and you decide to take out 5% instead of 4%. That gives you $50,000 annually, or around $35,000 to $40,000 after taxes. Congratulations, you've just given yourself a lower middle-class lifestyle for the rest of your life. You can pay rent on a modest apartment, buy groceries, maybe own a used car. You're not going hungry, but you're definitely not living the millionaire lifestyle that society promised you. No exotic vacations, no financial cushion for emergencies, no ability to help your kids or family when they need it. Just a permanent state of careful budgeting and hoping nothing major breaks. Now here's where it gets really interesting. Let's talk about what you actually need to maintain a middle-class American lifestyle without working. The average household in the United States spends about $70,000 per year. To generate $70,000 using the 4% rule, you would need $1.75 million invested. Already we're 75% above the magical $1 million mark, and that's just to live an average lifestyle. Not luxurious, not comfortable, average. If you want to live in a major city, add another 30 to 50%. If you want to travel regularly, help family members, or have any financial flexibility, you're looking at needing closer to $2.5 to $3 million minimum. But wait, there's another factor that nobody talks about. Inflation. While you're slowly drawing down your $1 million, the cost of everything you need to buy is increasing by about 3% per year on average. That means in 10 years, your $40,000 lifestyle will cost $54,000 to maintain. In 20 years, it will cost $72,000. Your $1 million isn't keeping up. Even if your investments are growing, the growth barely covers inflation and your withdrawals. You're essentially running on a treadmill that's slowly speeding up while you're getting tired. This is the invisible wealth erosion that destroys millionaires who think they've made it. Let me paint you a picture of what this actually looks like in practice. Meet someone we'll call Sarah. She's 45 years old and just hit $1 million in net worth. She's been saving aggressively for 20 years, and she's incredibly proud of this achievement. She thinks she's close to being able to retire early. She runs the numbers and realizes that with careful budgeting, she could potentially quit her job and live on her investments. But here's what Sarah discovers when she actually tries to make it work. Her health insurance alone costs $15,000 per year because she's too young for Medicare. Property taxes on her modest home are $8,000 annually. Her car needs to be replaced every 10 years, which is another $30,000 spread out. Unexpected medical expenses, home repairs, and normal life emergencies eat up another $10,000 per year. She hasn't even started buying food, paying utilities, or having any semblance of a social life. Her $1 million suddenly feels like a prison, not freedom. Here's the math that nobody wants to acknowledge. $1 million is the bare minimum entry point to even think about financial independence, and it only works if you're willing to live significantly below the lifestyle you probably currently enjoy. It's not the finish line, it's barely the starting line. And if you're under 50 years old, you need to account for potentially 50 years of inflation eating away at that purchasing power. The million you have today will feel like $500,000 in 25 years if inflation averages just 3% annually. That comfortable $40,000 lifestyle becomes a $20,000 struggle. But here's what makes this trap so insidious. The moment you hit $1 million, society tells you you've succeeded. Your friends congratulate you. Financial advisors tell you you're doing great. You see that seven-figure number in your account and you feel wealthy, so you relax. You start spending a little more because you feel like you've earned it. Maybe you upgrade your car, or move to a nicer apartment, or start traveling more. And without even realizing it, you've just locked yourself into needing that million to stay invested forever. You can't touch it. You can't use it. It just sits there, generating barely enough to sustain a lifestyle that feels disappointingly ordinary. This is the millionaire's paradox in its purest form. You have $1 million, but you're not free. You're just trapped at a higher level. The real question isn't whether $1 million is enough. The real question is, what number actually gives you the freedom you're imagining? And that's what we're going to explore in the next chapters. Because here's the secret that changes everything. The math completely transforms when you understand how the second million works differently than the first. Here's the secret that separates people who stay stuck at 1 million from people who build real wealth. Money doesn't grow linearly. It grows exponentially. And there's a massive difference between those two concepts that most people never grasp. Linear growth means you add the same amount each year. 100,000, then 200,000, then 300,000. Exponential growth means each year's growth builds on all the previous growth. 100,000, then 110,000, then 121,000, and the curve keeps getting steeper. The first million is brutal because you're fighting against the slow part of the exponential curve. The second million is where the curve starts working for you instead of against you. Let me show you exactly how this works with real numbers. Imagine you start with $0 and you save $10,000 per year while earning an 8% annual return on your investments. In year 1, your $10,000 grows to $10,800. Not exactly life-changing. In year 5, you've contributed $50,000, but your account is worth $63,000. Still feels slow. In year 10, you've put in $100,000 of your own money, but compound growth has boosted your total to $156,000. You're making progress, but it's grinding work. Here's where it gets interesting. By year 15, you've contributed $150,000, but your account has grown to $302,000. Suddenly, the compound growth has contributed more than your own savings. Now watch what happens as you push toward that first million. By year 25, you've personally contributed $250,000, but your account has exploded to $790,000. You're so close to $1 million you can taste it. But here's the critical insight. It took you 25 years to get to $800,000, and it will only take you 3 more years to hit $1.2 million. That's right. The last $400,000 comes in just 3 years, while the first $400,000 took you 15 years. This is the exponential curve revealing itself. The first million is slow and painful because you're building the foundation. Every dollar after that first million accelerates exponentially faster. But the acceleration isn't just about compound interest on your existing portfolio. It's about something much more powerful: the investment opportunities that unlock when you cross certain wealth thresholds. When you have $50,000, you're limited to basic index funds, savings accounts, and maybe a couple of individual stocks. When you have $200,000, you can start accessing better investment vehicles and diversification strategies. But when you cross $1 million, an entirely new universe of opportunities becomes available. Private equity funds that require minimum investments of $250,000. Real estate syndications that need accredited investor status. Venture capital opportunities that weren't even on your radar before. These aren't just different investments, they're investments with fundamentally different return profiles and risk-reward ratios. Here's a concrete example of how this works in practice. Let's say you have $1 million and you're earning 8% annually in a standard diversified portfolio. That's $80,000 per year in growth. Sounds great, right? But someone with $2 million earning the same 8% makes $160,000. They just made more money while sleeping than most people earn working full-time. And here's the kicker. That person with $2 million probably isn't settling for 8%. They have access to opportunities that can generate 12 to 15% returns because they can meet minimum investment thresholds and qualify as sophisticated investors. So while your million is growing by $80,000, their $2 million is growing by $240,000 to $300,000. The gap isn't just doubling, it's tripling or quadrupling. This is why the wealthy seem to get wealthier at rates that feel impossible to regular people. It's not just that they have more money, it's that their money has access to completely different mathematical rules. Think of it like a video game where crossing certain point thresholds unlocks new levels with better weapons and power-ups. At $0 to $100,000, you're playing on beginner mode with basic tools. At $100,000 to $500,000, you unlock intermediate mode with slightly better options. At 1 million plus, you finally access expert mode where the real multipliers exist. The game is fundamentally different at each level, and nobody tells you this when you're starting out. But here's what makes this even more powerful: the psychological shift that happens when you understand exponential growth. When you're grinding toward your first million, every setback feels devastating. The market drops 20% and you lose $100,000. That feels like years of work destroyed. But when you have 2 million and the market drops 20%, you lose $400,000. Yet psychologically, you handle it better. Why? Because you understand the curve. You know that when the market recovers, your larger base will generate larger absolute returns. You've seen the pattern enough times to trust it. This psychological resilience allows you to take calculated risks that people with less capital can't stomach, which further accelerates your wealth building. Let me paint you a picture of what this acceleration actually looks like over time. Someone diligently saves and invests for 25 years to hit their first million. They're 50 years old and feeling behind. They think they'll never catch up to where they want to be. But if they stay disciplined and keep investing, here's what happens. Million 2 comes in 7 to 9 years instead of 25. Million 3 comes in 4 to 6 years instead of another 25. Million 4 comes in 3 to 4 years. By the time they're 65, just 15 years after hitting their first million at age 50, they could easily be sitting on $5 to $8 million. Same person, same discipline, completely different results because the exponential curve finally kicked in. This is the fundamental truth that nobody explains clearly. The first million isn't the goal. It's the moment when the mathematics of wealth building finally start working in your favor. It's the point where your money starts making more money than you can earn from your job. It's the threshold where investment opportunities transform from basic to powerful. The second million isn't twice as hard as the first million, it's easier, maybe half as hard. And every million after that gets progressively easier, because you're riding the exponential curve instead of fighting against it. Understanding this changes everything about how you think about building wealth. Here's where things get dangerous. You've spent years building toward $1 million. You've sacrificed. You've delayed gratification. You've watched your friends buy new cars and take expensive vacations, while you've been maxing out your retirement accounts and living below your means. Then one day you wake up, check your net worth, and see that magical 7-figure number. And something shifts in your brain. Something subtle but devastating. You start thinking differently about money. You start feeling like you've earned the right to relax. You start believing that the rules that got you here no longer apply to you. This is the psychological trap that destroys more millionaires than any market crash or bad investment ever could. The trap starts with a simple thought. I've proven I can build wealth, so I can afford to loosen up a little. You upgrade from your reliable 10-year-old car to a newer model. Nothing crazy, just something a bit nicer. You move from your modest apartment to a house in a better neighborhood. You start dining out more frequently instead of cooking at home. You take that vacation you've been putting off for years. Each individual decision feels reasonable. Each one feels earned. But here's what's actually happening. You're experiencing lifestyle inflation. And it's occurring right at the moment when you should be doubling down on the behaviors that made you successful. You've reached the inflection point where exponential growth can really take off, and instead of accelerating, you're tapping the brakes. But the psychological trap goes deeper than just spending more money. It's about how your entire identity and social environment shifts when you hit $1 million. Suddenly, you're comparing yourself to other millionaires instead of comparing yourself to your former broke self. You start hanging out with people who earn more, spend more, and expect more. Your reference group changes, and with it, your perception of what's normal. That $50,000 car that seemed extravagant when you had $200,000 saved now seems perfectly reasonable when you have $1 million. That $200 dinner that felt outrageous before now feels like a normal Friday night. Your baseline for what constitutes reasonable spending has completely reset, and you don't even realize it's happening. Here's where it gets really insidious. The world starts treating you differently, and that treatment reinforces your new spending patterns. Credit card companies increase your limits without you asking. Banks offer you private wealth management services. Real estate agents show you properties that were previously out of your range. Everyone around you is suddenly validating the idea that you should be spending more because you can afford it. The message is constant and subtle. You've made it, so act like it. Enjoy the fruits of your labor. You deserve this. And that message is poison to wealth building because it confuses having money with being able to spend money. These are not the same thing, but the psychological trap makes them feel identical. Let me show you what this looks like with actual numbers. Imagine someone who spent 15 years building their net worth from $0 to $1 million. During those 15 years, they lived on $50,000 per year while earning $75,000, investing the difference consistently. They drove a used car, rented a modest apartment, and rarely took expensive vacations. Their savings rate was 33%. Then they hit $1 million and something changes. They buy a house, which comes with a mortgage, property taxes, insurance, and maintenance costs. They upgrade their car and suddenly have a $400 monthly payment. They start traveling internationally once or twice a year. Their annual spending increases from $50,000 to $75,000. They're still saving, so it doesn't feel irresponsible, but their savings rate has dropped from 33% to 0. Every dollar they earn now goes to sustaining their elevated lifestyle. Here's what just happened mathematically. They killed their wealth-building momentum right at the moment when compound growth was about to explode in their favor. If they had maintained their $50,000 lifestyle for another 10 years, their $1 million would have grown to approximately $2.3 million with 8% returns and continued contributions. Instead, by inflating their lifestyle to match their income, that same million grows to only 1.5 million because they've stopped adding new capital. They've traded $800,000 in future wealth for the psychological satisfaction of feeling successful today. This is the trap in its purest form, spending money to prove to yourself and others that you've made it, while simultaneously ensuring you never actually make it. But perhaps the most destructive psychological shift is what happens to risk tolerance and work ethic. Before hitting 1 million, you were hungry. You were motivated. Every dollar saved felt like progress toward a dream. You were willing to work extra hours, take on side projects, and make sacrifices because you could see the finish line. But after hitting 1 million, that hunger often disappears. You've proven you can build wealth, so the urgency fades. You start turning down opportunities that would have excited you before because they require too much effort. You become protective of your million instead of aggressive about building the next one. You switch from offense to defense, and in the wealth-building game, defense doesn't win championships. Playing not to lose is fundamentally different from playing to win, and that mindset shift is what keeps people stuck at 1 million for decades. The social pressure amplifies everything. You have friends who are still broke, and they start looking at you differently. Some become envious, some become resentful. Some start expecting you to pay for things because you can afford it. So you start seeking out new social circles of people who also have money. And those circles come with their own spending expectations. Country club memberships, private school tuition, luxury vacations that everyone else in the group can afford. You're not trying to keep up with the Joneses anymore. You are the Joneses. And there's a whole new level of Joneses above you that you're now trying to match. The psychological trap isn't just about spending more, it's about needing to spend more to maintain your social position and self-image. This is why understanding the psychological trap is just as important as understanding the mathematical reality of building wealth. You can know intellectually that the second million comes faster than the first, but if you fall into the lifestyle inflation trap, you'll never build that second million. You'll spend the next 20 years maintaining your elevated lifestyle while your net worth stagnates, wondering why you're not progressing despite having $1 million. The answer is simple but painful. You're trapped by your own success. You've built enough wealth to feel successful, but not enough wealth to actually be free. And that middle zone is where most millionaires live their entire lives, perpetually stuck between broke and wealthy, unable to move in either direction. Now that you understand the trap, let's talk about the strategy that successful wealth builders use to break through it. Because here's the truth. The people who build significant wealth don't just stumble into their second million by doing the same things that got them to their first million. They fundamentally change their approach. They shift their strategy. They start playing a completely different game. And if you want to move beyond that 1 million plateau, you need to understand exactly what changes and why. The second million isn't about working harder or saving more aggressively. It's about leveraging the capital you've already built in ways that weren't possible before you crossed the 1 million threshold. The first major strategic shift is moving from accumulation to optimization. When you're building your first million, your strategy is simple. Earn as much as possible, spend as little as possible, and invest the difference consistently. It's a grinding war of attrition, where your personal income and savings rate are everything. But once you cross 1 million, the game changes. Your investment returns become more important than your salary. If you're earning $100,000 per year at your job, but your $1 million portfolio generates $100,000 in annual returns, your portfolio is now working as hard as you are. This is the inflection point where optimization matters more than pure accumulation. How you invest becomes more critical than how much you invest. This shift in focus unlocks strategic opportunities that didn't make sense before. When you had $200,000 saved, keeping everything in low-cost index funds was the obvious smart move. Simple, diversified, low-fee, tax-efficient. Perfect for accumulation. But at 1 million plus, you can start thinking about strategic asset allocation in ways that create real alpha. You can afford to put 10 to 20% of your portfolio into higher risk, higher reward opportunities because you have enough base capital to absorb potential losses. You can invest in private real estate deals that require $50,000 minimums. You can participate in private equity funds. You can angel invest in startups. These aren't gambles. They're calculated risks that become statistically favorable when you have enough capital to diversify across multiple opportunities and enough cushion to survive the ones that fail. The second strategic shift is understanding the power of leverage. When you're broke or building your first million, debt is terrifying. Every dollar of debt feels like a chain around your neck. You're taught to avoid debt at all costs, pay off your mortgage early, and never borrow money for investments. This advice makes perfect sense when you're starting out because you don't have the capital or cash flow to manage leverage safely. But once you cross 1 million, leverage becomes a powerful wealth-building tool if you use it correctly. Smart, wealthy people use leverage to multiply their returns while managing their risk carefully. They'll borrow money at 4% to invest in assets returning 8 to 12%. They'll use margin in their brokerage accounts strategically during market opportunities. They understand that leverage is dangerous when you're vulnerable, but powerful when you're secure. Here's a concrete example of how this works. Imagine you have $1.5 million in investable assets. You could put everything into index funds earning 8% and generate $120,000 annually. Safe, predictable, reasonable. Or you could take a more sophisticated approach. Keep $1 million in diversified index funds as your foundation. Take $250,000 and invest in a real estate syndication requiring accredited investor status, targeting 12 to 15% returns. Take another $250,000 and split it between 3 private investment opportunities with asymmetric upside potential. Your base million still generates $80,000 safely. Your real estate position generates $30,000 to $37,000, and your private investments might generate anywhere from $0 to $100,000 depending on outcomes. Suddenly, your expected return increases from $120,000 to potentially $150,000 to $200,000 annually, with managed risk because your foundation remains secure. The third strategic shift is thinking about tax optimization as a wealth-building strategy, not just a compliance exercise. When you're earning $50,000 per year, tax optimization doesn't move the needle much. You're in a low bracket, you take the standard deduction, and there's not much room for sophisticated planning. But when you have over $1 million and your investment income starts rivaling or exceeding your work income, tax strategy becomes critical. Understanding the difference between long-term capital gains, qualified dividends, and ordinary income can save you tens of thousands of dollars annually. Using tax-advantaged accounts strategically, harvesting losses to offset gains, and timing your income recognition can significantly accelerate your wealth building. The wealthy don't pay less in taxes because they're cheating the system. They pay less because they structure their income and investments to take advantage of legal tax strategies that only make sense at higher wealth levels. The fourth strategic shift, and perhaps the most important, is changing your relationship with time and risk. When you're building your first million, your time horizon is often short and your risk tolerance is low because you can't afford major setbacks. A 20% market crash when you have $100,000 saved is devastating because it takes years to recover. But when you have $1.5 or $2 million, that same 20% crash is an opportunity. You have enough capital to ride out the volatility. You have enough cash flow to actually buy more assets when prices are low. You can think in decades instead of years because your financial foundation is secure enough to survive short-term chaos. This psychological shift allows you to make investment decisions that broke people simply cannot make, even if they have the knowledge because they don't have the capital cushion to absorb the temporary pain. Here's what this looks like in practice. Successful multimillionaires maintain what's called a layered risk strategy. They have their foundation layer, enough safe, liquid assets to cover 3 to 5 years of expenses. This layer never gets touched for risky investments. It's their security blanket. Then they have their growth layer. Invested in diversified index funds and traditional assets, this layer grows steadily and predictably. Finally, they have their opportunity layer, capital specifically designated for higher risk, higher reward opportunities that can generate 10 times returns. This layered approach allows them to be simultaneously conservative and aggressive, safe and risk-taking. They protect their downside ruthlessly while maximizing their upside aggressively. This is the strategy that builds multiple millions, and it's only possible once you cross the 1 million threshold. The final insight about the second million strategy is this. It's not about working harder or earning more from your job. It's about putting your existing capital to work more intelligently. The second million comes from optimizing what you already have, not grinding for new income. It comes from accessing better investment vehicles, using leverage strategically, minimizing taxes legally, and taking calculated risks with money you can afford to lose. This is why the second million is the real test of financial sophistication. Anyone with discipline and time can save their way to 1 million. But building the second million requires actual wealth-building skills that most people never develop because they get trapped by their first million's false sense of security. So let's talk about the question everyone actually wants answered. What's the real number? If 1 million isn't enough, then how much do you actually need to be financially free? And here's where I'm going to tell you something you probably don't want to hear. There is no universal number. There's no magic amount that works for everyone because financial freedom isn't about hitting a specific number. It's about reaching the point where your assets generate enough passive income to sustain the lifestyle you actually want to live, with enough buffer to handle the inevitable chaos that life throws at you. That number is different for everyone, and pretending otherwise is just another trap. But we can work backward from some realistic scenarios to give you a framework for thinking about your own number. Let's start with the minimalist scenario. Someone who wants to live simply, has no desire for luxury, and is comfortable with a modest lifestyle. To generate $50,000 per year using the 4% rule, you need $1.25 million. Add a safety buffer for unexpected expenses and inflation protection, and you're looking at closer to $1.5 million as your absolute minimum for basic financial independence. This isn't retire to a beach in Thailand money. This is live in a low-cost area and budget carefully money. It's freedom from needing a job, but it's not freedom to do whatever you want whenever you want. There's a difference. Now, let's look at the comfortable middle-class scenario. Someone who wants to maintain a typical American lifestyle without working. You want to own a modest home, drive a reliable car, take occasional vacations, and have some financial cushion for emergencies and unexpected expenses. You're looking at needing $75,000 to $90,000 per year in actual spending power. Using the 4% rule, that requires $1.875 million to $2.25 million in invested assets. But remember, this assumes you own your home outright with no mortgage. If you're still paying housing costs from that income, add another $500,000 to $750,000 to your target. So, realistically, you're looking at $2.5 to $3 million for comfortable middle-class financial independence. That's 2 to 3 times the mythical $1 million milestone that society tells you is enough, for those who want more than just comfortable, who want the flexibility to travel internationally, live in a nice area, help family members financially, and have real freedom to pursue expensive hobbies or interests. You're looking at needing $125,000 to $150,000 annually in passive income. That translates to $3.125 to $3.75 million in invested assets, assuming the 4% rule. Add in home ownership, emergency buffers, and inflation protection, and you're realistically looking at $4 to $5 million as your target for genuine lifestyle freedom. This is the number where you stop thinking about money for most daily decisions, where you can book a flight without checking prices, where you can help your kids without it impacting your own security. This is where financial freedom starts to feel like actual freedom. But here's the really important insight that nobody talks about. Your freedom number isn't just about the total amount. It's about the gap between your passive income and your expenses. Someone with $2 million generating $80,000 per year who spends $70,000 annually is more financially free than someone with $5 million generating $200,000 per year who spends $190,000 annually. The first person has a $10,000 surplus that grows their wealth further. The second person has a $10,000 surplus despite having more than twice the capital. Financial freedom isn't about the size of your pile. It's about the relationship between what your pile generates and what you need to sustain your chosen lifestyle. This is why lifestyle inflation is so devastating to financial freedom. Every time you increase your annual expenses by $10,000, you need to add $250,000 to your freedom number using the 4% rule. That nicer apartment that costs an extra $1,000 per month? You just added $300,000 to the amount you need to retire. That luxury car payment? Another $200,000 added to your target. Every lifestyle upgrade comes with a massive price tag in terms of the capital required to sustain it forever. The wealthy understand this instinctively. They ask themselves, is this expense worth adding hundreds of thousands of dollars to the amount I need to be free? Most of the time, the answer is no. So what does this mean for you? It means you need to get brutally honest about 3 things. First, what lifestyle do you actually want to live in retirement or financial independence? Not what your friends expect, not what society tells you successful people should want, but what genuinely makes you happy and fulfilled. Second, what does that lifestyle actually cost per year when you strip away ego and social pressure? Third, based on that number, what's your real freedom target? Multiply your desired annual spending by 25 if you're using the 4% rule, then add 20 to 30% as a buffer for the unexpected. That's your number. That's what you're actually building toward. Here's the framework I want you to remember. $1 million is not the destination. It's the foundation. It's proof that you understand the basics of wealth building. It's the platform from which you can start building real financial freedom. But it's not freedom itself. The second, million, is where you start to feel the exponential curve working for you. The third million is where you start to have real options and flexibility. And somewhere between 2 and 5 million, depending on your lifestyle choices, is where you cross into genuine financial independence. The exact number matters less than understanding that you need to keep building past that first million. The trap isn't hitting 1 million. The trap is thinking that 1 million is enough and stopping there. If you take one thing away from this video, let it be this. Financial freedom isn't about hitting a number that society chose for you. It's about building enough wealth to sustain the life you actually want to live, with enough margin for error that you never have to worry about money again. For some people, that's $2 million. For others, it's 10 million. The number doesn't matter as much as the clarity about what you're building toward and why. Stop chasing the mythical $1 million milestone and start building toward your real freedom number. And if this video changed how you think about wealth, hit that subscribe button and drop a comment telling me what your real freedom number is. I read every single one, and I want to know what financial independence actually looks like for you. Now go build something that matters.